Hello and welcome to another episode of ATG TV. Today we're going to follow suit and continue our conversation in regards to the new HUD-1. Before we start, a little background. Back in 2010, Congress passed a bill. It's called the Dodd-Frank Act. It was a bill sponsored by Congressman Dodd and Congressman Frank. This was in response to the whole meltdown crash of real estate market back in 2008. Two main things that came out of the bill. Two of them took effect January 2014. One is the ability to repay. The lender has to make sure that they get all their T's across and I's are dotted as far as qualifying a homeowner to get a loan. And if there's any default, in future default on a loan, the lender has a burden of proof to make sure that they've done everything in their power to document all the paperwork to get the loan for the homeowner. Second thing was that came out in 2014 was the QM, was a qualified mortgage. Basically, all the conventional loans have to meet certain parameters before they can qualify as a QM, qualified mortgage. The first one is the lender cannot charge more than 3% of closing costs on the loan. Second thing is no risky loans. There's no more negative amortization, no balloon payments, and a third thing is all the loan has to be 30 years or less. These are the main points as far as the QM is concerned. And there's one more point that I forgot to mention is the DT ratio, which is the debt to income ratio. Basically, all your debts cannot be more than 43% of your income. That's combined. All your credit cards and mortgages cannot be more than 43% of your income. And the third, I would say, law or main change coming out this year, August 1st, is the new HUD-1. We discussed briefly in our prior episode about kind of going over the forms, but the main thing that's very important that you have to pay attention to is the lender has to provide the loan estimate and the closing disclosure, which replaced the old HUD-1 good faith estimate, 3 business days prior to closing, or the new term for closing is going to be called the consummation. So the lender has to have proof of delivery. So it's going to be very, very tricky. And most lenders are going to have to do is actually mail the documents 7 days prior to closing in order to avoid having to prove that the borrower received those documents. So it's very important for all you realtors out there, when you write a contract, to make sure it's at least 30 days out, if not 45 days, to give your lender ample time to get the loan approved and comply with all the new changes. Thank you for watching, and if you have any questions, call me. My direct number is 703-629-2935. You can email me at mo@atgtitle.com. Thank you, and looking forward to seeing you in the next episode of ATG TV.